what are some of the ways in order to kind of protect yourself? And again, the psychological part is important here, but how do you stop the chop?
Yeah, I think I think the first question that I generally ask myself, and a lot of people asked us over the years is, can you stop the chop,
Yeah.
right? And still, be get in the market at somewhere near the lows. Uh, I don't think you can. I don't necessarily think you can completely avoid the chop. You have to put a little money to work when you get those signals. Uh, that's the biggest thing. You really have to put that money to work and get some feedback from the market.
Hmm.
Now, so you are going to get if in these really choppy, tricky markets, you're going to give some back. The key is not giving too much back.
Hmm.
That's why you want to play really, really small. And so a lot of times what I'll do is like, so I'll tell what I've done this year, right? So I start out early in the beginning of the year, like 5% positions,
Hmm.
right? And those got whacked. And so then I reduced it to like 2% positions. Then I started making a little bit of progress and went back to the 5%. Now I'm down like to 1% positions,
Hmm.
right? Because I my 2% positions that I tried a few weeks ago, they started blowing up, and so now I'm now down to 1%. I'm not trying to make money at this point. I'm trying to get traction in the individual, the one or two positions that I'm taking. I want to just see some progress. Now going back to the fall through day that we had in uh, end beginning of July or end of June, that
Hmm.
ended up like a 5 week rally there. Uh, all the little positions I took, and those around 5% positions, and I slowly started scaling those up. They actually made some progress, right? They were it was weird. It was like, wow, they're not getting killed. So that was giving me feedback that we might have a chance here. But once they started selling off, you back away. So it's that process of actually putting a little money to risk, not a lot, to slowly get that feedback, because we know using our system that once we kind of see the traction, once we start seeing the stocks moving, we can quickly move into the market, right? We can get into that next stock that's breaking out. We can scale up those positions to, once they're really working, you're going like from a 2%, 5% position to a 20% position, right?
Right.
But you're not starting off with a 20% position, starting off with a 10%, then you bring it up to six, add 6 more% to it, and then finally four. So you're scaling in that way. But at a beginning of bull markets, and when you're in strong markets, a lot of times we're going to have five positions, each of them 20%, right? So we know we can make a lot of the ground that we might have missed by not being there at the bottom pretty quickly in strong markets, because we're gonna really kind of make up for that with stock selection and concentration.
Yeah.
That's kind of the key. That's why I think it gives us a little bit of a luxury of play small, and then once you start seeing the traction, starts market starting to work, start the stocks starting to work, then you become more aggressive.
Mhm. And it's as you said, it's feedback, right? The market is giving you that feedback that you're making good decisions, that you're getting that traction, and that's what allows you to get more aggressive. But certainly, I'll tell you where I was 25 years ago, and I know I've shared this story. First of all, it was a such a strange time to start because the late 90s, it was like you could throw a dart and everything was going up, right?
Right.
So it was almost like you think you're a genius, especially when you're a young punk kid, fresh out of college, just learning about the stock market, and you think you can't do any wrong. But then you get a situation like 2000, 2003, where I was so eager to make that money and get back to the late 90s where it was so easy. I kept on going in hard each and every one of those rallies. And I would be on margin within days,
Yep.
and that's a real easy way to get chopped up. And what what was the worst part about it is I got out so good in 2000. I went to full cash in March of 2000,
Wow.
and was just patting myself on the back of how awesome I was. But then by the time 2003 rolled around, I had I disintegrated my account by 50%. It was over 50%. Now, the good news I had so little money at that time. It wasn't it wasn't like I lost a huge sum, but still, percentage wise, I'm glad I made that mistake early and not now.
Yeah, you bring up a very good lesson right there. I mean, if you're new to this, especially to the methodology here, you have to play small, play very small, because the stocks that we end up playing in, they move up fast, they move down a lot faster. Now, getting back to you, kind of that other statement that you said, Justin, with when markets are strong and you think you're a genius, right? It's not really you at that
Yeah.
point, right? It's the market. It's the same way. If you got caught in this bear market, and we've all gotten caught in them. I got caught in that 2000 bear market that Justin was able to avoid, but I learned my lessons, and I've been able to kind of manage not getting crushed in these other bear markets that we've had since then. But the key is you're not that bad when the in the bear market. Yeah, it's not like you're an awful stock picker, or you're just know nothing, right? You're just in an awful market. No one it's very very difficult if you're trying to go long to make money in a bear market, right? A lot of people will ask us, oh, why don't you just go short? Well, for me personally, I find it a lot harder, right? So a lot of times I just prefer not to play. If I'm going to go short, I just play very very small on it.
Mhm.
I'm never going to go aggressive, even though you look back and go, man, I could have done really well going short. I knew that this market was in trouble for a while. I should have just gone the other way, but I've always found it hard. So I generally just kind of stay more on the sidelines and just wait. So that's up for everyone to kind of decide for themselves. But shorting is, I've found, much harder than going long. But I think the big thing is, you want to kind of learn from this and know that in the end, it's the market, right? And so it's up to all of us to listen to the market. And that's
Mhm.
what these small positions, when you put them on, you're just getting feedback from the market saying, okay, is the environment changing or not? And it's going to tell you that just by, are you making progress in your portfolio or not?
Right. And there's a little bit of patience that's required,
Yeah.
especially for folks that have had some success in the market. And I'm sure this happened to a lot of folks that started in 2020. You're like, wow, this is awesome. I'm making money, and you start getting to a point where it's a sizable sum that you're making, and when that's kind of taken away, it makes you sad.
It's awful.
Like
It's awful.
you want those good times back. And but there's two things. Now, one of the first things that happened, I feel like, with some of these rallies that we were getting this year, is that there were no stocks behind them. A lot of times what was happening is you were seeing a lot of the bottom fishing, right? It was your upstarts, your Shopify's, your stocks that were down 80%, that were just bouncing off the bottom. Those were some of the ones that were driving some of these rallies, these false rallies. And that's not our style, right? It's not our style
Yeah.
to get into those bottom fishing type stocks. And so it was really easy to kind of sidestep some of those false rallies. What was a little bit trickier is now we've seen a lot of these names kind of have this much better relative strength. The indexes are below their 50-day and 200-day moving average lines, and you start noticing the stocks that are holding up above their moving average lines, or even making, they're close to new high territory and forming bases. That's where it can be tempting. But to your point, it's that feedback, right? If you're picking the right stocks, and a lot of people would say this has been a stock pickers market, right? If you're picking the right stocks, you can make progress. But if you're in the wrong stocks, uh, or the market itself, it's been pretty terrible. So you've got to kind of use that feedback mechanism. And I think that patience level too means don't feel like you have to be getting in at the very bottom. We don't buy at the very bottom, and we don't sell at the very top, but there's a lot of room in between there where you can make a lot of money. Um, just by being kind of 80% there. You don't have to get 100% of the move.
Yeah, no, it's ego, right? A lot of times you just gotta be able to walk away and say, it's not my time. This is not my environment, and that's okay. You don't always have to try to make money. There are plenty of times where the right decision is to stay on the sidelines or play really small. Some other suggestions to kind of avoid the chop or really stop the chop in many ways is, and this is something that I learned from Scott St. Clair. Take a bunch of money out of your account.
Yeah.
Scott's always been very good at that. Where
Charles
if he
does that
get
too.
and Charles does that, yeah. So it's like a number of these guys who've done really well have been able to, be able to keep most of their money. Right?
Hmm.
It is they will just literally take the money out of the account and
Hmm.
put it in their bank account. Just take it out of the trading account so they're not tempted.
Hmm.
So now you're playing with a smaller amount of money, and so now even if you go 100%, you're just really a 10% maybe,
Right.
so they're like taking like 50% of their money out, maybe even more than that, right? So that's the I think that's another good suggestion. If the markets are tempting you, like if it's calling you, when you have those quotes kind of constantly flashing, you feel like you have to do something. Yeah, I think
Hmm.
that's another thing. In bear markets, when markets are really tough, I try not to watch. I try not to watch the quotes too much.
Hmm.
I'll put the charts to weekly charts.
Uh-huh.
And so to try to, because all those little signs, especially when you're looking at the quotes, all those little colors flashing, those are
Right.
triggers, right? They make you itch. You really want to do something, and you get that urge. So I just try. I cover the quote screen. I put something else on there, or I walk away from the computer.
Yeah.
I go, I kind of stay away from the computer and go and read or do something else, and focus on some research or some stocks or some trends or whatever, but not watching the screen because I know the market is bad and we're a few days away from a fall through day and all that kind of stuff. So I think those are a few things
Hmm.
to do. But the biggest ones, the feedback. But I think the other thing is just realize your emotions, right?
Yeah.
You have to know that you're going to get emotional and you have to learn to manage that.
Do you ever scream at your screen and just say, "Leave my dopamine alone"? Like, I know what you're trying to do. Um,
Honestly, I'm happy to say that I'm past that where I really start screaming and all that kind of stuff. I don't have too many of those kind of episodes
right.
anymore, which is good.
Uh,
Which is not, but that's experience, right?
yeah.
Like a lot of times the highs you can put like when you're doing like 2020 when we were all doing well, we could kind of put it in perspective, saying, this is acting too well.
Right.
We're
Right.
not this good, right?
Yeah. Yeah.
It's like we better start figuring a way to lock in some of these games and keep this money because this is one of these once in every 20 years type of events. And then the same time when you're in a bear market and everything you try just fails, like I'm not going to get too down on myself.
Hmm.
I'm going. I realize the market's changed, so I'm just going to go smaller and just kind of try to keep most of the money that I have right now, and just wait. It may take. We know that it's going to last this long? No, I thought that
Hmm.
by now it would probably be getting pretty close to changing, but we don't know. Maybe we do get a falter and it changes this week, and maybe the next great bull market starting next week, or it might be next year, right? So we just don't know. But I think the biggest thing that we all have is, and the biggest advantage we have using this methodology is that once you see these signals start coming, and you just start seeing, and we saw it in July, you saw a number of falter days start happening, right? I mean, that was kind of a good little preparation, I think, where you
Hmm.
saw a number of falter days happening, you saw a number of stocks working well. It just didn't, and the rally worked a little bit, right? It went up like 15%, 10 to 15%. Uh, so that was kind of a good practice. There's going to come another time where you start seeing that again. And
Hmm.
so you just let the market slowly pull you in. So that's what I've always had over the years as kind of my safety net, that I know that I'm not going to really, knock on wood, but I shouldn't miss, anything's possible. I definitely could miss the next rally, but uh, I shouldn't miss the next rally because there are enough signals there to keep giving you reason to get exposure in the market when the
Right.
time is right.
And a lot of those, as you said, you're dipping your toe in, you're dipping your toe in, and eventually, you start getting to a point where you're like, oh, things are really moving, and I need more exposure so I can participate in this. And again, that's where things start cooking. Of course, I think it is important that people do keep that perspective in mind. As you said, 2020 was one of those very unusually strong time periods, and you can't look at the next rally as necessarily being the same as that, right? I mean, we had a Fed behind us, stimulus money, liquidity, going crazy. That that kind of created a perfect storm. And so don't be surprised if the next time, you're not making, 100% in your stocks in just a few weeks. It could be a little bit slower going, but that's okay, because you catch a few of those big winners, and you can still have your life changers in there. Just don't expect as many as maybe we had in 2020, and maybe to the degree.
Yeah, well, and I'll say, like, you brought the Fed and stuff like that. Now you're kind of seeing the effects of the Fed the other way, right? Where now the money, as you said, is coming out of the system.
Right.
Things could get bad, and there are plenty of people out there, really smart people, as Tom said last week,
Hmm.
um, that are convinced that this market's going to go much lower, right? Things are going to get much worse, and they very well could be right. A lot of what they say makes a ton of sense. Like, this market could get really bad. But the reality is this market's gone down a lot already.
Hmm.
The markets are always anticipating, they're always looking at 6 to 9 months. And so you want to be open minded to the fact that, okay, yeah, it seems like the market is going to go down a lot lower just by the fundamentals, by the charts, all this kind of stuff. But what if we're at the lows right now or near the lows and we get that signal? What do I do? You have
Right.
to kind of catch yourself, because a lot of times that's what I'm always like. I'll, I, I'll let these things influence me too much and get too negative, right? And then I'm a little slower to get back in. So you always have to kind of catch yourself. Like, wait a minute. What if we get that signal? Can I shift and go against kind of the grain,
Hmm.
where all the news out there is terrible, right? And the Fed is removing liquidity and rates are going through the roof, and no one's going to be able to afford anything, and companies can't buy new things, right? It's terrible. But
Hmm.
the markets are always looking 6 to 9 months ahead, and when the markets are ready to turn, they don't care. The markets do not care about the current news. It's always looking out ahead.
Yeah. And that mentality, it often gets the most negative, right before things turn around, or even things turn around sometimes, and it's still very negative. You still have all those negative headlines, but at the same time, we see this so many times where some of the stocks that you're looking at, you might still be saying, well, no, this, the price is going down, but look at the earnings, look at the fundamentals, they're still so strong. And it's not until 6 months later that, then you start getting the clobbering of the fundamentals, and it's like, oh, okay, the market really is a leading indicator, not a lagging indicator. So well, I think we can wrap it up right there. Any last words of advice here, as we close this out, Arusha?
No, the biggest thing is learn from this, right?
Yeah.
There are plenty of lessons to learn from. I do not like doing post analysis, but I force myself to do it every year.
Mhm.
And good or bad, you want to go back and learn, because this is a never ending process of improvement. And if there are bad things, if there's been a bad year, we've all gone through it. The most important thing is learn from those mistakes so you don't have to go through it again.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.